Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the upcoming, or this is for the prior week, ending Friday, January 23rd, 2016. What I'm going to do on this weekly update is show a couple of slides here that I just kind of cut and put in, and then we'll go to the charts. A couple of these things are very important though. And as we take a step back and just take a look at the start to this year, very interesting. The worst start to any year in the markets. And this past week, we actually had a little bit of a bounce. In fact, it was the first week this year that we had an up week. But what I've got on the screen here is the CBOE put call ratio. I'm sure a lot of you have heard of it. But in case you haven't, or in case some of you have not heard what this means, essentially you take puts and then you put them in the numerator and then calls in the denominator. Basically, puts are just a bet in the option market that you want to make money if things go down, and calls you want to make money if things go up. Okay, well, whenever you have these spikes up here like that, that is the traditional area where a lot of retail traders, most traders in fact, come in and just start buying a lot of puts out of fear that the market is going to crash. Now, an interesting thing about this ratio, and it is a great contrarian ratio, and I like to use it once you get up over 1.2 to 1, right about in that area there. Generally, as you can see, you don't stay up here very long. You don't spend a lot of time up here. And the reason why is that most traders, the general public, is wrong. They generally put on a lot of puts and start protecting their portfolio after the portfolio has already crashed, after the market has already crashed. So we use this put call ratio as a form of contrarian indicator. And the other thing that I wanted to show you about this chart, and the reason why I'm bringing it up here, is that you can see right up here, just a few weeks ago, back in what we had here in 2016, or in August 2015, we had a huge spike in puts. And at the very time we made these lows here, which said be ready for a snapback in the markets. So basically this whole area here that I shaded in yellow, generally when we get up here, you can expect a complete reversal of the markets in just a few days. And that's what we got. And then of course, if you look here, what we saw just a few days ago, we were down here, and then we got that snapback that we saw on Friday. Now, sometimes that snapback doesn't last. And as you can see here, and I'm going to show you on the charts, we moved up, then we rolled back over again, and then we snapped back up again. But we failed to make new highs, which was kind of telling everybody, or at least what I was telling our group, we can expect it to roll back over again. The other thing that I want to show you about this chart that I really find very interesting is that look at how high we are right here over the past 6 months in these spikes. And then look back over here in 2008. You could see back here when we had the 2008-2009 crisis where we just gave it all up. The put call ratio never really got over 1.45, maybe 1.46, right in that area there. That was the high point. But look at what happened here when we had that flash crash on Monday. And then just a few days ago when we just really moved up, or a week or so, about a week ago when we moved up this past week, huge a spike in volume, meaning more than 1.5 puts, 1.6 puts bought for every one call. And generally because the market is generally, or the average trader is generally wrong, the public is generally wrong. When we get up in this area here, we can expect a pretty good snapback in the markets, and we don't know if it's going to happen that next day or the day after. We need a trigger for it, and that's what I work with our members on. But when we find it, it is a great place to be because it doesn't happen very often. Now, this is a weekly chart, so sometimes we stay up here for a week. Like in this case right here, we were back up in this area for 3 or 4 weeks. but you get this wide swing in volume, and they're great opportunities to take advantage of in that kind of market. But look at how high we were right here compared to back over in 2008. Now, some of that additional altitude here is based on some more of the high frequency traders and algorithms and other hedge funds coming in where they're just loading up a lot quicker than they typically would have in the past, not John Q. Public. But I think John Q. Public and most rat brain traders out there are always wrong. Their timing is almost always off. And that's why when we see these spikes as traders, we want to take advantage of them. So this is just one. Now I go into a lot of detail on assets that we can go long in to take advantage of these things. But I just wanted to just point out to you, this is one thing that that we're looking at here. Another thing I wanted to show you is when the risk is not in the marketplace. I call it risk off environment, right? When no one wants to take any risk. We've got a scenario where and you can see it, and some of them serve as early warning. But you can see in a risk-off sector here, stocks above their 200 EMA, meaning those that are doing fairly good. These are risk-off. You can see the S&P 500 right here. Roughly about 26% of the stocks are above the 50 EMA. Not that many, really. 3/4 of the stocks are below the 200 EMA, and 200 is a longer-term average. But if you look at the utility sector, you got 82% of the stocks in the utility sector above their 200 EMA. So again, flight to safety in a crazy market. XLU tends to do well, which comprised of major utility companies. Another one that tends to do better than average is Staples, XLP. Here you can see over 60% rush to companies that are in the consumer staples, food companies, tobacco companies, alcohol companies, those types of things. And then another traditional risk off sector is healthcare. In this case here, about 34% above their 200 EMA, not as good. And part of what's dragging it down are biotechs. Traditional healthcare prior to the entry of biotech has been a risk-off environment because people need their medicine, good or bad markets. That's what they need to do. So generally, there are always areas. In fact, the utility sector was one of the only sectors going into this past week that was actually in the green for the year. So when we see utilities start to get stronger, as they started to do here in September of last year, going into Q4, and then continuing that strength in 2016, we got to pay attention to that. Now, let's go look at some of those sectors that are considered not risk off sectors. These sectors are considered the kind of sectors where when risk is on, people want to take risk in the market. And now let's go down to a 50 EMA, and let's look at the percentage of stocks in a couple of the other sectors that when risk is on. And you can see just how poorly they're performing right now. You can see here again as a benchmark, the 50 EMA, the SPX is about 19%. So over 80% of the stocks right now in the SPX, in the S&P, are under their 20 or under their 50 EMA. And I did that run this morning. So that was as of, even with that large move up we had, you still have 80% of the stocks in the S&P below their 50 EMA. Now let's look at energy. This is god awful. The energy sector, only 3% of the companies. And this is with that big run that we've seen in energy on Thursday and Friday, that counterbalance that we've had. Still, only 3% of the companies are above their 50 EMA. And if we look at the, let's see here. If we look at the, I got to read the chart here and let's see what we got here. Materials and industrials. Still very, very poor, down very low, 12%, 3%. just horrible. And a lot of the materials and industrials are basically because there's just no manufacturing. I think we've been in a manufacturing recession for the past 4 months in the United States. Globally, they're already in a recession. If you look at the profit and loss and the PE ratios and the performance, we've been underwater for the past 2 quarters in the manufacturing sector. Just not good at all. And now let's look at the other risk-on sectors and look at their performance. Again, not very good. We can see, again, the SPX up here, as I said, around 20% roughly. I think it's like about 20% or so. But if we look at, or 28, 26%. But if we look at consumer discretionary, 23%. Okay. We look at financials, 22%. So 23%, 22%. Okay. And this includes that big run that we had on Friday. And we look at technology, looks like, let's call it 28% for technology. Okay. Still very, very low. Very low. Now, there's going to be some great opportunities here on any counter trend bounce. And, for our members, I'm going to go through some great places where we can play on any of these bounces, right? So these are just some things that I'm going to be looking at here for our members coming up. Which reminder, for our members, we have a session this Sunday night at 8 p.m. New York City time. Now, looking at just the S&P, not an individual sector, but let's just look at the S&P, right? And let me just clear up my screen here for you real quick. If we look at just the S&P, all of the S&P grouped together, percentage of stocks over the 50 EMA, 17.8%, okay? That is all sectors, all everything. And you can see the SPX where we've come down. And we just barely took out, but we did take out our August lows last time. But notice the performance is not quite as bad. A little bit of a divergence setting up. And for our members, yes, you'll know what that is. That is a bullish divergence, even though it got decimated. And you can see here the 30 and the 60 percentage lines are put in dash marks here because this is going to be our next resistance level, and where we can bounce to. And if you'll remember, back in August where we had that flash crash, we came up, we rolled down, we finally bounced up to that 30 level before we gave it all back up again. And then we had the big massive move where we finally caught wind. So now the question is, what do we expect this time? I can tell you from the charts that I'm going to expect some pattern similar to this. It could be even worse because this point in time right here, the economy is not viewed as favorable as that point in time right there. Earnings are coming in under estimate globally, from China to Japan to Europe. Inflation is negligible. Earnings performance is nowhere near where it should be. So we're setting up here for possibly more ugliness. Now, understand we can get these bounces. I mean, that's just normal. That's what we would expect. Let's look at the NASDAQ percent of stocks over the 50 EMA. Again, not very pretty, right? And if we just kind of group all of NASDAQ together, you can see here 9%. Literally 9, and that includes Friday's bounce, huge bounce, 9%. You can see that was a low in the flash crash. We're coming down. Didn't quite hit that. Same thing here. We actually went down to zero. Not one stock of the 100 stocks which are the largest stocks in NASDAQ were above zero. So we're back down here. So we're due a bounce. And again, up into this area here, as you can see right here in this larger zone, we came all the way up, we bounced down, we tested it, and then boom, off we go again. So I'm going to expect the same thing to occur this time as well. Okay, I don't see anything on the charts right now. It's a little bit too early to call this as a bottom. And I'm sure some of you are watching TV and looking at the talking heads on TV, and some are trying to say it's a bottom, some aren't. But you can't really do that. We just have to go by day price action and play accordingly. However, the odds favor a roll back over again. So we still got to be very defensive in this market. Now, if we look at the S&P and the stocks over 200 EMA, a little bit longer term, but again, almost 25%, right? And we are back down here, and you can see, as I said on another chart, we actually made a lower low there, but we made a higher high here as well, right? So we can expect a bounce up into this range, but then we've got to be very cautious of any potential rollover. The odds favor that. In fact, that's what I'm looking at seeing here in this rollover. I'm looking to see that kind of thing occur. So that's a little bit about where we're sitting here. One other chart I like to show our members, I'm just going to include it in here for you guys, just so that you can see it here. Just two charts, actually. One is the yield curve. We watch this very closely. It's not a chart that you trade off of, but it's a good leading edge indicator of deflation, inflation, stagflation. And the nice thing about this chart is it's very, very difficult, if not almost impossible, to manipulate by the government. Well, we got central banks coming in and doing what they need to do, but this is very hard. And what it does is, this is the red line is the 30-year bond. The black line is the 10-year. The green line is the 5-year, and then the blue line here is the 2-year. Notice since all of 2014, right? And it takes time for this to come to be. All of the higher, longer term, except for the 5 years, starting to flatten out. But these up here, the longer term, 30-year, 10-year, down to the 5-year, we've been going down. Interest rates have been declining, but yet notice the near term interest rates have been going up. What this does is it results in a compression of all the rates to a point where the difference between the 10-year rate and the 5-year rate basically come together, and you have what's called a yield curve. When this moves zero, it's almost 100% accurate in depicting a recession. Right now, it's at 1.19. The danger area is starting at 1.20 going down. We're at 1.19, call it 119 basis points. That's the difference between the 2-year and the 10-year. We've got to be very watchful of this, and that would mean these rates are going to compress more. Typically, we see a rise in the 2-year and a drop in the 30-year, more dramatic than the 10-year. The 5-year, as you can see, is relatively steady. So we've got to watch this very closely. Again, another early warning indicator for us to track here. And then one final one that I think you'll find very interesting. It's a monthly seasonality chart of the VIX, the volatility. If you're not familiar with that, it basically measures the volatility of the markets on a 30-day go-forward basis, but it's projected for today. So it's a cash. It kind of shows the cash value of volatility today, and you can see. We're in the month of January now, and the way you read this is 55% of the time, the VIX is going to close higher at the end of January than where we started in January. Okay, but not by much. Maybe by, according to the chart, it's say by 0.9%. Okay. Now, if we look over at the worst month, it's right here, July. You've heard the term sell in May and go away. 60% of the time at the end of the month, volatility is higher than when it starts. But, again, statistics are one thing, but you can't use them to trade, because if you look at December, it was at 47%, meaning anything under 50% is more bullish. The most bullish month, volatility speaking, from a seasonal basis, is November. 26% of the time. So about 3/4 of the time, volatility falls in the month of November, where it ends and where it begins. Okay, so just a really interesting chart. But the key things I wanted to show you were those correlation charts and the breadth of the market, and with the percentages of performance, where everybody is and what everybody is thinking, and then these sentiment indicators, which is the put call ratio, and how you know, you hear the term contrarian investor, and you want to, you know, if everybody rushes to one side of the boat, you want to be on the other side. So let's go take a look at the charts here real quick. And I just want to show you guys, you know, what I'm looking at and what we can expect. So I'm just going to stick with the E-mini S&P 500 futures for now, and we'll just kind of dig into it. I think you remember this chart. I've shown it the past couple of weeks. I always start off with this view here, just so that you can see, you know, where everything is. Okay. So now looking at this chart, you can see back here, that was the bottom back on March 9th, 2009. And then this was the top where the E-minis was 2134 in May 2015. And then I just plotted some Fibonacci's. Notice here, now this is not an official fib number, 0.236, but I love to use it because I find that the markets in a very bullish market tend to pull back to that area and then shoot off again. We can still see in a bullish markets pullbacks all the way down to 50%. On a weekly chart or a daily chart, generally the more common for the index is this one right here, and then sometimes you'll get this one right here. So what was I expecting? I was expecting a pullback to this area right here, around 1787. We came down intraday very close, you know, and I'll show you on a daily basis where we came to. But you can see where we actually took out the lows from last August, and we made that lower low, and now we've got this move up. This is a weekly chart. I'm going to zoom in just a minute. I believe that we're going to get some altitude up here, and then we're probably going to roll over and then test this line again, probably come down and test it. So if let me just blow this chart up just a little bit, but I'm going to leave it on the weekly chart for a minute, just so that you can get a better idea. Let's just zoom out a little bit. Okay, so here's the weekly chart again. And you can see on this weekly chart where we did come down, and we almost hit this low here, or actually we did. We actually bypassed it. So let me just turn my pen off here for a second, and I'm going to show you. That was the low made then, and this was the low made on this day here. So we came down to 1804, okay? And you can see as I stretch it out here, you can see that last August, intraday 1831, this time 1804. Folks, that was a key break. The fact that we took out last August flash crash low really concerns me. Now, if you look at last August, you can see we did have a very strong rally. It lasted about 3 weeks. So that would say going into the first week in February, we could have a rally here. But then all of a sudden we gave it all back up over the next 2 weeks, which would take us through the middle to the end of February. And then we started that rocket ship run, okay? So I would expect something similar here, or at least a snapback rally taking us somewhere up in this range right here, okay? So we're saying, you know, it could take us up to around 1920, all the way up, possibly up to, you know, 1990 area. I could see that happening, and I would not be surprised at all. If I were to draw some key areas on the chart rather than me just trying to pin it in here, I would see that up into, let's call it this area right there, 1992 is a very good snapback rally mode. And that's where I could see us running up to, you know. Now we're going to have some fits and starts, but I can see us running up into that mode. You can see back here in August, we went here down to 1831, and we actually moved all the way back up here over 2000, right? So we had a nice snapback rally. In fact, if I were to, let me just put a marker on it to show you guys right in that area there. And then if we were to come in here and just kind of measure that move, let's just from a symmetry standpoint, right about there. So now that was the run right there, that snapback rally. It was about, it was 9.97%, okay? So if I were to come in here and do let's call it 10%, right about what it was. So if we were to have on a measured basis the same thing, it puts us right about here, right at that 9.92. So that would be where I would expect a snapback rally, assuming symmetry works itself out. We're not always assured that it will, but that would not um, uh, uh, bother me at all. And then up in this area here, what's going to happen? I think the odds favor, assuming we make it up there. It'll be choppy up there. We're going to roll back over, and then it'll be some big down moves, and then we're going to have a test here. If we break this 1804 area, we got the fib sitting right there. If that breaks and we move up above and it breaks back again to the downside, or it finds resistance here and rolls over, that scenario, folks, is going to take us back to the highs of the dot-com bubble era and 2008. That's what's going to happen. What is that level? Well, let me just zoom back out and I'll show you where we're heading to, or where we could head to if those key levels get broken. If I move my chart over like this, and let me just clean this up here so it doesn't get in your way or just confuse you a little bit, especially if you're watching this video on a tablet or a smartphone. You can see here the dot-com bubble. Let's see here, bear with me 1 minute. Let's get this. I'm just adjusting a couple of things on my screen. But the dot-com bubble was right here. The 2008 bubble was right there, extending the fib node, boom, all the way over. Perfectly timed, just like that. In fact, let me zoom out just a little bit more on this daily chart. And I'll show you again, just so that it just doesn't get all discombobulated there. There it is right there, okay? So looking at that chart, this is a weekly chart. I've condensed it all the way back to about 1995, okay? But you can see there extending, my line's not very straight, but extending the 0.38 fib node, and that is a natural. That's a natural fib node. That would put us in the dot-com bubble there, and 2008 there, those highs. So again, we won't get there in 1 day or 1 week or 1 bar, but it could take us 6 months to get there, where we fight it, and then we give it up, and then we do one of these kind of things, and then we just have one of these kind of moves like that, and then boom, we're there. 1573, roughly 1574. Now, I'm not saying that's where we're going to go. I think with this market here, barring any surprises, we'll find a bottom somewhere around 1790, 1780. But I'm going to watch very closely where we are right in this area here, because if that breaks, then you can pretty well bet that, and I'm going to play it like the market's going to come down to around 1574. Okay. And again, just and I went over it last weekend, but if you didn't pick it up, the difference between a market and a correction and a bear market, because I'm sure some of the TV talking heads are talking about, hey, we're in a bear market. But when you have right now, about 70% of the S&P stocks are an official bear market, 30% are not. The indexes are not. So now the question is, will the main market drag down those stocks that are holding up, or will those stocks hold up and then those stocks that really just got tanked start performing better? Well, if we look at it from an index perspective, and we look at what is right now, we are sitting right now at about a 15.9 roughly. That was kind of where we went to. Low, right? That was about how far down we went, give or take, a little bit. But now let's measure it again, and let's say, what would it take to get us down to about 50 or 20%? So a 20% move is roughly right around 1700, 1704 area. Okay, so if we go into that would be my line in the sand. If we can maintain above, if we break 1787 and we just kind of, the selling accelerates, then I'm watching that 1704, 1705 area. Call it 1700, that kind of psych area. that may hold. If it does, then, you know, we're not in a bear market territory. If it doesn't, then boom, that is going to be my trigger to say, okay, we're coming down to test the dot-com bubble highs, the 2008 highs. So that's kind of how I'm looking at this chart, folks. Now, if I take it off the weekly, and let's just zoom in real quick. And let's just do one of these kind of things so that you can see a little bit better. I'm leaving the Fibonacci on here like this. This is a daily chart. Now, you can see right here, this was the flash crash low last August, right there, 1831. This was, as I said before, 1804 that we took out before, and then we've got the 1787 where I was expecting the markets to go this first time. Okay, now the run up that I would be expecting would be somewhere in this area here. I think I called it 1992, right up in that area. You can see where we had a lot of resistance up in this area right here. It was resistance getting above there, and then it was support holding up there. So typically what's resistance becomes support, what support becomes resistance. Okay, so over here it was our R1 value, that was resistance. Right here it was our S1 value, our first level of support. So now, what are we going to see? Well, look at this pattern right here. I would expect something similar where we have this bounce, this run up, something like that. We may run into a little bit of problems. It starts to roll, then we come back up. We challenge this area right here, and then the big question is, what are we going to do in this area right here? Are we going to be able to take it out, or are we going to roll back over? And if we roll back over, what is going to firm up for us? I expect this to be the expected or the anticipated move, but then what no one can tell, I can't either, you know, is this going to hold? If this holds and it starts going up and we're making higher highs and higher lows on the daily basis, then the bottom has been formed, at least for the near term that I would define as you know, 90 to 120 days out. If it hadn't, then the bottom is still, we're still searching for the bottom. Okay. The other thing I wanted to show you here is if we look at time, how long can this bounce last before we expect a roll? Well, if you'll see here, we came down here and it literally took us 3 days to get up to 1992 from 1831. Okay, 3 days. That was it. And then we started to roll over and we caught ourselves. I think some people said, okay, the drop is done. And then we spent the better part of 2 weeks, 2.5 weeks coming up, actually taking out that line, which even got more people bullish, and then immediately rolled over. Came all the way back down, almost tested it, right? And that this time frame from this point here to this point here is about 5 weeks. So we spent about 5 weeks playing around with that. And then when we made this low here and we started up, that told me with that big bullish divergence, or as we say in our group of Bud, that was a smiley sign. I'm going, okay, let's scoop up some stuff. Let's really take it and go to the long side. And then that's, you know, pretty much what we did. However, you can see we did not come in and take out the highs. We made failed high attempts, and then all of a sudden we just gave it all back up again. This is why this pattern concerns me more than this pattern right here, because we failed up here again, and we're at the end of a long-term our cyclical bull market within a secular bull market. So I think we can go back lower. We're going to make money in this move up, but then we're going to make some even more money in the move down. So for our members, I'll see you Sunday night. I'll identify some things that we can play. If you're a non-member, I highly encourage you to come in and check us out. I hope you enjoy these free updates for the weekend. And I would encourage you to come in and take advantage of some of our offers. All right, everybody, have a great weekend. For those of you on the East Coast, which is where I am, today is a snow day, so I'm just in my office, just you know, relaxing and going through the charts. Have a great weekend, everybody, and I will see you next weekend for another weekly roundup. Take care, folks.